Wonderful good day from Munich, Commodity TV, and it's news time, ladies and gentlemen. We want to report about Altona Mining, South American Ferrometals and Timmins Gold. All three companies reported their quarter numbers. Let's start with Altona Mining. Altona Mining showed again a solid quarter with profit and is now debt-free. The debt was repaid 2 years ahead of the schedule. This was funded from cash reserves and by $8.3 million realized from closing out copper and zinc hedging. Little EVA feasibility was improved so far. A cost review of the May 2012 definitive feasibility study was completed by GR Engineering Services, delivering improved outcomes with an all-in cash cost of $1.96 per pound of copper and a low capital intensity of $6,700 per annual copper ton produced at an exchange rate of US dollar to Australian dollar of 0.89. The resources were upgraded at the Kililahti mine in Finland. The resources increased after mine depletion of 161,000 tons of contained copper equivalent from a resource of 8.8 million tons at 1.33% copper, 0.78 grams of gold and 0.54% of zinc. In the December quarter, copper production for the Outokumpu project was very strong again. Year-to-date copper metal production of 7,223 tons remains on track to meet upgraded guidance of 9,000 to maybe 10,000 tons for the year. The March quarter C1 cash costs of $2.37 per pound of payable copper was high as forecast due to above-average mine development. The June quarter is expected to see an improvement in grade and cash cost performance. The company's cash balance remains healthy at 15.8 million Australian dollar after the early repayment of the debt. Again, Altona had a profitable half-year result. They recorded a profit after tax of 4.3 million Australian dollars per December 2013 half-year. This is the third consecutive half-year that Altona has recorded a profit. South American Ferrometals back in the positive cash flow zone, ladies and gentlemen. The company recorded quarterly sales volumes of 317,000 tons of beneficiated product, an increase of 34% from the previous quarter. The implementation of cost reduction and efficiency programs aimed at reducing production costs to $21 this month. Also, they made significant progress on the bankable feasibility study and in the expansion of the project. What were the primary developments over the quarter? The necessary metallurgical test work required for the bankable feasibility study is now complete. Variability test work is being finalized in order to verify plant design factors. RMC, a Brazilian mining consulting company, is completing the mining feasibility study and the pipeline routes have been agreed. Hydraulic calculations and equipment sizing have been completed too. The rail load terminal design is being finalized by a local company certified by rail operator MRS and anticipated to be completed by June 2014. The final environmental licensing strategy was defined. It is anticipated that the installation licenses will be granted within the next quarter. CEMIG has completed the design of the power transmission line route from grid substation to the South American Ferrometals HV switchyard. The company recorded a positive net operating cash flow from the operations, of course, of $2.67 million for the March quarter. The company's capital projects utilized cash expenditures of $3.2 million, mostly related to the settlement of the waste and tailings property and the bankable feasibility study. The company's cash balance at the end of the quarter was $4.1 million. All is well underway for the expansion plans from 1.5 million tons per annum to expand the production to 8 million tons per annum. Our third company reported is Timmins Gold. The Mexican gold producer recorded metal revenues of over $47 million compared to $45 million during the last quarter and compared to Q1 2013. This increase over the prior year is primarily due to increased ounces sold, offset by the decrease in the gold price since April 2013. The average London price fix was $1,294 per gold ounce compared to $1,632 per gold ounce during Q1 in 2013. The average realized gold price was $1,280 per ounce compared to $1,602 per ounce in the comparable quarter. The earnings from operations were to $12.9 million compared to $19.3 million during Q1 2013. This was mainly due to the reduced revenues realized from the lower gold price. Earnings and total comprehensive income was over $8 million or 5 cents per share compared to over $14 million or 10 cents per share during Q1 in 2013. The cash flows provided by operating activities were $12.3 million compared to $21.8 million during the comparable quarter. Cash and cash equivalents at March 31, 2014 were over $44 million after investing $500,000 each on exploration and on the sustaining capex and $1.6 million on expansion programs and over $3 million on deferred stripping. Cash and cash equivalents at March 31st were $26.9 million. The company produced a record 35,413 ounces of gold and sold a record of 36,763 ounces of gold compared to 28,328 and 28,642 ounces respectively during Q1 2013. This change over prior year is due to increased throughput and crushing capacity. The company's cash cost per ounce on a byproduct basis was $703. All-in sustaining cash cost per ounce on a byproduct basis was $790 compared to, again, $703. All-in sustaining cash cost per ounce was, on this time, on a byproduct basis, $872 during Q1 in 2013. The maintenance of cash costs was primarily driven by cost reduction initiatives offset by lower grades realized in Q1 2014 of 0.76 grams of gold per ton compared to Q1 2013 with 0.83 grams per ton gold. On 11th February 2014, the company closed a bought deal financing which generated net proceeds of over $24 million on the issuance of 19 million common shares of the company at a price of $1.50. On 28th February this year, the company repaid $4.5 million in principal of the $16.4 million loan facility outstanding at December 33, 2013. Timmins Gold did well in a weak gold price environment and is prepared to grow organically as they have at least 3 to 4 properties which they can explore and build a production for the future. That's it, folks. Thanks and bye-bye from Munich.